We move on to our next session. Next session is on capital allocations in 2022 from the lens of global investors, which will be moderated by Mr. Shobit Agarwal, Managing Director and Chief Executive Officer, ANAROCK Capital. With over 20 years of experience in real estate investment, he is responsible for driving growth in investment banking with a focus on structuring joint ventures, raising equity and debt, advisory on disposals and acquisitions in core markets. Mr. Shobit Agarwal will be joined on this panel discussion by Mr. Irfan Kazi, who's the Chief Investment Officer of Swami Investment Fund, with 27 plus years of international work experience in alternate investments. Mr. Irfan has held senior investment responsibilities in 8 funds, including that of CIO in 4 funds. An alumnus of Jamnalal Bajaj Institute of Management Studies and an Indian charter holder from CII, Mr. Kazi has been primarily active in real estate private equity investments at asset management companies such as ICICI Venture, Everstone, AIG Global Real Estate, and L&T Infra Investment Partners. We would also be having Mr. Nitin Idani, Managing Director and Co-Head of Equities, Axis Capital Limited. Mr. Nitin Idani has been part of the investment banking coverage team at Axis Capital for the past 5 years. Prior to investment banking, he spent a decade in Axis Capital's research department as the lead analyst covering real estate and infrastructure, where he has been ranked as a leading analyst by various bodies. We also have with us Mr. Vipul Rungta, who's the Managing Director and Chief Executive Officer of HDFC Capital Advisors Private Limited. Mr. Rungta is the Managing Director and CEO of HDFC Capital Advisors, and it's one of the largest private equity funds in India for the development of affordable and mid-income housing. HCAL, which is currently manages funds with a corpus of approx $1.1 billion. He has a cumulative experience of more than 20 years in the real estate sector across mortgages, fundraising, structuring investments, equity credit, and asset management. We also have with us Mr. Vikas Chimakruti, Chief Executive Officer of Kotak Realty Fund. Vikas Chimakruti, sir, joined the Kotak Investment Bank in 1999 and has over 21 years of work experience in the financial services industry. Prior to Kotak Realty Fund, Mr. Vikas was in the M&A team of Kotak Investment Banking. With this, I hand over the stage to Mr. Shobit Agarwal to take forward the conversation and the discussion, please.
Thank you, Pushkar. Thank you, CII. Thank you, ANAROCK, for hosting the session. And thanks all my fellow panelists for being there, taking out time. It's a pleasure, as always, to be with you, all of you. Before I start, and it's very appropriate to the subject that we have got such diverse sort of pool of capital that you guys are all representing, right? We have Irfan doing sovereign, we've got Vikas doing private equity, Vipul doing private equity, and Nitin, of course, you are representing a lot of the investors in the public space. So it really is very unique how this panel is set up, and to get the best out of it, I'll try and set up some questions for the audience to enjoy and learn from this panel. Irfan, let me start by you. Your fund is almost, if I would say, it's almost close to sovereign setup as it can get. Its mandate was to handle stress for the home buyers, not for the developers. And you've been doing so now for 3 years. So my first question to you is, what's changed for you? How do you feel about it? Would you want to get more allocations done? Would you like to change something? Has the objective moved from trying to help the home buyers secure their houses in stuck or delayed projects? And where are you in this process? How many deals done? How many home buyers rescued? Where are you? How do you measure yourself?
Thank you, Shobit. Thank you for this opportunity. What has changed is, you've seen an idea blossom into a policy announcement into an operational initiative on the ground. And we've, went further along. We've just to set a context to the numbers, we have a system of giving prelim approvals and final approvals. And we've given final approvals to about 105 deals, which will complete about 61,000 homes. We've given prelim approval to about 144 deals, which will complete another 85,000 homes. So in all, we are targeting to complete about 249 deals, which will complete almost about 150,000 homes, right? So that has changed. About 3 years ago, this was just an idea of a scale and size that was not comprehended by most of us when we started off. And therefore, we've learned a lot along the way. We've been learning a lot along the way, and we've been able to do things, achieve significant progress, primarily because we've realized very early on that uh, if there are two things that really matter for us to grow at the rate that we were targeting to, one was to take our social impact objective very, very, very seriously, right? The number of home buyers affected is as important to us and will always be more important to us than the, so many of the financial details in the deals, so much of the risk that we are taking, and so on. So that was one bit. The other bit is, it's possible to scale up to this size and at this speed only if you are part of an empowered team. And I'm scared to even say I lead the team, right? Most of my principals can take most, if not all, the decisions that are that need to be taken on any deal. They lead the deals, and it goes all the way down. So everyone, including analysts and associates, are presenting deals, analyzing deals, meeting developers, and therefore I think to if I have to mention that the single factor that has helped us along the way is the fact that there were 36 empowered individuals leading this fund.
If one quick question, I didn't know that you made so much progress, so great to note that progress and the relief to home buyers. But my quick question, this is a little bit emotional. Do you get a sense of fulfillment that you've been able to solve something that was stuck, both for home buyers, and how does it impact the bankers that were there on this deal? Are they also seeing the benefits of Swami Fund? Of course, it wasn't meant for their benefit, but are they enjoying that sort of solution that you're putting?
So we do get a huge emotional satisfaction, right, from the fact that what we are doing is helping people so much. The fact that people come and say that if it was not for us, the homes would never have been completed, and so on. And the fact that we are saying more than we are investing, we are analyzing, and so on. We've actually completed handover of about 2,500 homes. We are targeting to complete about 10,000 homes this year, and so on. So that matters a lot. At the same time, to be fair, there are a lot of home buyers who keep writing to us and telling us, why haven't you sanctioned for a particular deal, and so on. And honestly, if we could, we would, but we can't, so we don't. Right? We keep trying. We do not drop a deal. We try and find a solution to every difficulty that exists. But these are problems created over time. We aren't magicians. We need to solve them in a way that we can also justify to our investment committees. And we need to find a robust solution, a solution that once we enter a project, we will be completing the project, right? We will not be set back. And therefore, we need the cooperations of everyone, including home buyers, including the existing lenders, the developer, and so on.
Irfan, thank you. Speaking about stress and you solving stress, I'll probably bring in Vikas. Vikas, you've handled certain situations from your special situation fund, which perhaps may or may not qualify for Swami Fund, but there is lots that is outside of that box, if I might use that word. How are you seeing that market develop, and do you still like the credit risk on special situation projects? How are you handling it?
So, Shobit, as long as we don't become a special situation ourselves, that's fine. Right.
That's nice. That's nice, of course.
So I think more when we look at all the transactions which we looked at it was I think classified into problems of over leverage, where developers had taken significant amount of loan, and they faced challenges at the customer end, where volumes dipped in 2019, 2020, and the capital providers had got their own challenges because of IL&FS crisis, could not deploy capital, right? And so it was a liquidity challenge more at the top line as well, from the revenue side, as well as from for whatever capital was to be pumped in by the capital providers for construction. So it jammed the entire system. And that got to a great extent got resolved, I would say, by Swami. And where Swami could not enter, players like us entered. Otherwise, Swami has to leave something to players like us to earn our bread and butter. And at that cost of capital, we can never give capital. So there was a segment where it was higher mid income, upper mid income, or luxury, and where existing NBFCs were looking for capital. That's where players like us came and deployed capital, and the market also has turned around very well. So, so as long as one does not get into special situations, kind of a situation, you're happy.
So you're saying there are opportunities to coexist. Swami can solve something, and there are projects and enough abundant projects that require private capital, private credit at far different terms because the risk is very different to solve for, and there are enough opportunities to solve for. I'll quickly go to Vipul. Vipul, we've spoken and probably started the note on stress, but let's move on to our happier situation. First of all, congratulations for raising new capital. So I understand, and as your description came, I was thinking affordable and mid-market. But from this pool of capital, is your strategy still going to be the same? Or do you have flexibility to do newer stuff, innovate in the capital stack for Indian real estate, or is it going to be just plain simple affordable housing?
So from the new pool of capital, we have just done an initial close. We will be doing affordable and mid income, slightly more broad based. But I think time has come because like if you look at whatever is being talked about by all the experts in our sector, and all the pundits who are talking about macro things, with the cycle turning, there is tremendous scope for growth. Nitin, I think, has graded more in last 1 year than all of us cumulatively, because every developer is now chasing Nitin for equity and debt to everybody else, which is what it is mostly. But um, yes, I think simply providing finance to fund this growth is not enough. So what we have also done is we have flexibility to invest in this fund, to invest in companies which are enablers to a developer. So the tech ecosystem, we have provision to invest in services companies which will be efficiency drivers for the fund for the developer ecosystem. So it's financing, debt and equity, but also a certain portion has been carved out for equity funding of enablers.
So you're saying backward integration so that the efficiency comes on to the developer and eventually to the home buyer, right?
With experience of last whatever number of years in real estate, anything which says backward, I don't agree with that. So we say yes, forward integration.
Forward integration. So, okay. So I
Meaning
think
is the same, yes.
integration, forward integration. Speaking of, private equity, I think, no conversation can be done without talking about public markets. We have Nitin with us. Most recently, he's helped two of the large listings on real estate, starting with Macrotech and then Shriram Properties. This has happened after a lull of 10 years, almost a decade of no listing. And then suddenly there is like a piper, everybody wants to go towards public markets. Nitin, what has changed for these companies and the investor perspective, saying why there's suddenly so much demand for paper on real estate?
Now, first of all, I must thank all these three gentlemen who tend to make developers scale up to a size where they then that I can help them to try and list. but you're right. It's been a decade since pure equity in its truest sense. I mean, it's been elusive. I mean, more so in the private space, but in the public space, I would say now you've seen some amount of that come back, right? I mean, real estate, real estate public markets have had a very checkered past, right? We all know the amount of wealth destruction that has happened in the past, and investors have been a bit scarred and a bit biased, and do tend to have a dual lens when they're looking at this sector. But if you look at it in the last 5 years, I mean, post RERA, the winds of change have already been coming, right? And the REITs really helped get investors come back to the real estate space. I mean, REITs are regarded as low risk. It was really easy for people to make that call and back the annuity sort of plays. Residential was where there was always a lot of selective investing. And I mean, that's the consolidation that we all talk about. I mean, there are different kinds of consolidation. One is buyer consolidation, one is lender consolidation, one is landowner sort of wanting to only stick to the large developers. And then there is the investor consolidation, which has always been there. I mean, beyond the 8, 10, 12 names in the listed space, investors have not been keen to evaluate beyond that because there was enough to sort of take exposure just in these names. But I think over the last maybe 4 quarters now, more 3 than 4, but with the kind of volumes that most developers have been able to demonstrate, I think it's almost like a consensus buy-in from investors that the residential upcycle is here and it's here to stay. Some call it a decadal upcycle, but at the very least, someone will at least give in that the next 4 or 5 years you're going to see a significant uptick in residential. So I do believe that there is going to be a lot more equity raising from the capital markets perspective. But like I said, there is a certain amount of consolidation. You are going to have to tick a lot of those boxes to be able to get that capital. So it's not going to be there for everyone. There are several criteria that investors would want to see. A lot of it is housekeeping, disclosures, corporate governance, all that is taken for granted. Size is still a very important filter. Public markets tend to like margins of safety, and I think that I've seen them ask for a lot more margin of safety in real estate than any other sector. And one very important sort of safety net for them is liquidity. And if they need to see, ability to exit positions as well, which is why companies that will come with, smaller market caps, smaller floats, will always find it far more challenging than someone who has already built scale.
Understood, Nathan. So you're saying scale is important, liquidity is important, corporate governance is a given. But one quick question before I move back to some of the other colleagues is, how do you value these companies? I thought in 2010 we were saying so much land bank, so much FSI, I will build so much. So is it the same lens through which investors are seeing it, or something has dramatically changed on how these companies are evaluated?
So, I mean, this sector has its origins in the public markets, maybe in 2006, right? When you had the early companies come to list. I think it's been a learning curve for everyone, and the lens, the valuation lens with which investors have looked at real estate developers has also changed over time. Yes, there was that. Today we can, on hindsight, say foolhardy approach of saying more land, more value. And then realization dawned that, look, you can't execute all of this in the time frame that these guys are talking. So execution became far more important. Lehman happened, balance sheet became the most important thing. So leverage was an absolute no. I think around 2010, 11, there was a certain sort of opinion that was getting formed that you need a bit of everything, right? I mean, you need track record, you need a good brand, you need a certain amount of visibility of cash flow, you need some growth inventory in terms of future development. And a combination of all of that made, few of the names stick out and the rest to really fall by the wayside. I think that's just been built upon over time, with a lot of those sort of speed bumps, if I can call it them, the RERA, the GST, the DMON, etc. All of that just helped to sort of sharpen that lens a bit more. And today, I think the public market investors are extremely well informed, and they are very they can take a call based on a gamut of factors and not just one or two or three. A lot of weightage is given to having the whole package rather than just one or two redeeming factors, one or two prime assets today. And that's really how it should be. And uh, you know and I'll just take a minute more to explain this one very sort of nuanced thing from the public markets point of view. Public markets, all other sectors, you tend to look at the P&L a lot, right? Because of the way real estate accounting works, the P&L in real estate is more a function of what you have achieved in the past rather than what you're doing at present or the year gone by. And a lot of investors have struggled with that over time, right? I mean, a lot of the return ratios are in the single digit for real estate companies. Some of it has to do with legacy issues, balance sheet ballooning up, over leverage, and all of that. But for the large part of it, the PNL is something that still does not give you the full picture in real estate. It's still a cash flow business, and I have seen that sophistication of understanding this nuance and willing to back in real estate companies which may not best financials but have got the best visibility of flows also come through in investors. So I would say that there has been a change in that valuation lens. It has evolved, and we've reached a place where I think investors now can make a very well informed decision of who to.
So you're saying there's a lot more transparency in the sector. It's gone up leaps and bounds. Cash flow is priority, not land bank, and of course sales, because more than P&L, it's the top line and the ability to sell that really makes you stand apart. I'm assuming, Nitin, that the big boys will gravitate towards public markets if they are already not listed. Let me go back to people who are still not there and require help from likes of Vipul and Vikas to help them scale up their companies before they can approach you. So one quick question to both of you, and maybe Vikas, you can take it first, and then Vipul. I'm assuming that when we used to speak about 5 years ago, I guess all of us were a little less experienced. Today, my sense is that between both of you, you've seen over 100 exits, entry and exits, very successful. In most cases, some would have given you some pain. When you now look at doing fresh investments, how much weightage would you give to quality of partner? Leave alone assuming everything else equal, right? Everybody has decent governance, the project is nice, but in whose hand is this project? How much weightage would you give to that? First, Vikas, you can take a shot at it, and then Vipul. I can't hear you, Vikas. Sorry.
Project in the hands of a quality player obviously makes life easy for investors like us because governance standards are good, execution is good. You don't have to spend so much amount of time monitoring it, right? But uh, unfortunately, for a player like us, our return targets are far higher, and with those kinds of return targets, the proportion of some of the big boys being our partners in a credit kind of a situation is low. Yes, if you have equity, yes, you make good partners. But in a credit kind of a situation, that kind of becomes ability to get real top grade. So let's say you are talking about people like Prestige, Lodas, and all those words. Uh, Getting them, probability of that is low. One of situations you will end up with, but most of our players in our business, at least for our fund, are more mid-tier kind of players. And so fortunately till now we have been able to manage it well. Those players have scaled up over a period of time. They have delivered. I think as long as controls and processes are strong And if the counterparty's intent is good, he may not be a big player. As long as the intent is good, I think you are in safe hands because you have to target those returns. If you have equity capital, yes, obviously you have the luxury to choose the kind of partners you want to work with.
Thank you, Vikas. Over to you, Vipul.
Okay, before I answer the question, Shobit, I would like to ask you, do you mean quality means size? Is that what you're saying, that top quality are the say, the top 20 people?
No, I'm not necessarily saying top 20 people. I'm just saying top 20 on overall basis. It's not necessarily the size. But
So
let's say the
frankly,
top 10 are listed.
in my
So
opinion,
let's say
I
the
am not.
top 10 are listed. Hmm. Sorry,
Sorry,
go ahead,
please go.
Vipul.
No, frankly, in my opinion, Shobit, I have not seen any list which lists the top 25, 30, 50 players. If it is beyond the size or sales, there are, I think the entire industry is searching that who is the top 25. And as Vikas put it, I think the lucrativeness of lending, whether it is giving money at 6% or giving money at 16, or it's giving money at whatever rate you're giving, is purely a function of intent. I know top-notch developers who are taking debt at rates that Vikas would love to give it them at, and I know some not so good guys who may be taking at ridiculously low rates. So it's a function of, I think it's a function of, most importantly, being relationship oriented with the developer and understand what is the exact pricing of the risk that you're taking. I'm talking more on the credit perspective, because the same developer may take the money at a different rate depending on what he's getting out of it. So one of the things that we try and do is, like what we are trying to do in our new this thing also, is it's not that much about cleaning up what is existing. Irfan has done a brilliant job. So a lot of guys that Irfan has funded and brought them out, we are saying now you need growth capital. And in growth capital, if you're making $100, then we don't mind funding you and being getting half the return that you are getting in percentage terms. So it's about pricing your risk.
It's about pricing
Top
the risk.
developer size, I'm not so sure. I know some really big guys who are taking rates, so fine, yeah, but there's nothing called top 25 in my opinion in our industry.
Yeah, maybe I'll let Irfan come in, because for him developers don't matter who it is. I think the structure is very different. So Irfan, just a very quick question to you. When you are looking at projects, and I'm assuming that when we are talking to you about 2, 3 years ago, the challenge was other lenders not cooperating in terms of giving you senior secured and giving NOCs. And there were demands about upfront cash out, you take me out. How's all that changed? Is there a sort of a cooperation that's coming in? Is there are the ducks getting aligned in the right manner with the right spirit, so that you can reach and solve this 150,000 homes that you're doing? And how much support do you get from the government to help you get to this number?
So Shobit, even before I answer that, let me just pitch in with what Vikas and Vipul were saying, right? Investment is rarely a blue sky mandate. You have a specific mandate that is given to you by investors. The kind of instrument that you're targeting, the kind of returns that you're targeting, and what flows from the returns is the kind of risk that you are going to take, and therefore the quality of the companies that you are going to be dealing with, right? So similarly in our case, right, our mandate is social impact. Our mandate is to help stressed projects, right? And therefore we cannot rely on the bio of the or the resume of the promoter to take investment calls. Regardless of how the promoter has fared in the past, regardless of whether there have been incidents with the law or not, regardless of whether money has been completely utilized in the project or not. Our mandate clearly says that we are here to complete homes. It is looking at the home buyer, and therefore that is far more important to us than the reasons that led to the trouble, right? So we cannot take the crutch of the reasons that led to the trouble as therefore saying we do not want to invest in those projects. So that's my bit to the earlier question. Actually, to answer your question directly, right? There was a lot of apprehension when we came in about whether whether we would get a senior charge, whether a mandate was by design there was a problem, there was a in it, and there were soft whispers about it that we would not get a senior charge and therefore nothing could be done. So rather than comment about it, we let stats and track record speak loudly and boldly, right? So we've given final approval to 108 deals. Of them, 57 deals have lenders who've given their NOCs, right? So that is the extent to which lenders have come along with us. And there are several nuances to it as we've discovered along the way, right? So when you push and you prod and you keep moving in the right directions, you keep finding solutions. So what we've seen along the way is, one, because we are a sovereign fund and because we have given sanction to a project, the existing lender has decided to step in and complete the project on his own. So that's what we call almost an infinite return for Swami, because even without investing, we've acted as a catalyst in completing the project. The other bit is when lenders have given an NOC for the project, or in some cases and in many of our cases, we are seeing that the lender is being prepaid. Existing lender with a small balance is being prepaid so that the lender is out of the equation and therefore we get a senior charge immediately. We are also seeing NBFCs work out a solution where some cases in their portfolio are acquired by AIF, and then the AIF approaches us, because an AIF does not have so many issues about first charge and second charge. But we've seen reluctance from banks. I can admit to that straight away. We've seen reluctance from banks, and that is primarily because banks have another alternative solution from the same government, right? So banks have this emergency credit guarantee line, and they've used that as a very effective solution for decreasing the stress in their accounts. So while we've seen a more sedate response from banks, the fact is, like I said, more than 50% plus of the deals we have got lender approval. And we've tried to get lender approval in various ways. So one is almost immediately within a month or 2 months of starting, we announced that we would do sharing with the lender. So maybe up till 10, 20, 30% of the revenues from the project would be shared with the existing lender. And sharing is a tough way of putting it, especially from the Swami point of view, because it's not like the remaining 70 or 80% is coming to the Swami fund. We are insisting that the remaining money is plowed back into the project. So it's more like 0% for us and 30% or 20% for the existing lender. But we've not been able to, by a mandate, by the crux of our mandate, by design, we have not done refinancing. Now that's I believe that's a different approach to the same problem. There are a couple of issues that are related to it, which we tackle in a slightly different way versus another lender who might approach refinancing with lenders. So I think the two big issues there are, what is the risk return that you're looking at, right? Most refinancing players would look at a return of 18% plus, 20% plus. We do all our deals at 12% and nothing else. So that's one. The other is the quantum of financing. So without refinancing, we are able to put in all the capital that is required to complete the project, right? Vis-a-vis, I think when refinancing is involved, most or a large part of the capital goes into refinancing, and maybe 30, 40, 50% of the cost to complete is available. So the amount that is committed to completing the project and the rate at which the financing will be available is different in both these cases. In a case like Swami, where there is no refinancing, and in the case where other funds would do refinancing, and there's no right or wrong there. They are just two different approaches to solve the same problem.
Thank you, Irfan. I think you've explained that very well, and also we've understood the innovation you've done in Swami to tackle the sort of banks and other people who are involved. Speaking of innovation, Vipul, I can't let you go without you talking about, or without me having you to talk about rental housing, because I think we've spoken a lot in all our previous sessions about affordable housing and mid-market, but we all know that rental housing is coming. And what's your view? You're dealing with it from different angles. So can you just tell us a little bit about that segment?
First of all, I would disagree with, I think Mr. Junjunwala yesterday was saying that rental housing in India is a no-go.
Yeah.
Or it makes no sense.
I will convey that to him separately after this call.
I would definitely want to get into a little bit of a discussion, because what he's saying is what is been there ever since real estate in India has been, because of high interest rates and the difference between mortgage and rental yields on residential. But I am very confident that we are nearly there. It is being done in very small factors, that yield on residential can be increased, and the answer to that is, unfortunately, for some of the setups, is not co-living. It is not putting a furniture layer on a house and increasing your yield by from 2% to 6%. I think it is pretty much about creating efficiencies in the cost. Can I do the same thing, better designed, lower priced, more efficient construction cost? And can I maybe do the same thing in 1 year versus 4 years? And then I look at my yield to cost. There is a tremendous market in affordable mid-income housing. If we are today at the X number as far as the market is concerned, the 3.5 lakh odd units which are being sold, the rental housing market is, if you capitalize that part, is about 2 to 3x of that. And it is going to come, whether we are part of it or not is not material.
So you're saying government is conscious about it, they are thinking, and they are soon going to act and legislate, and we all believe that the size of that market could be bigger than REITs if we play it right.
No, REITs could be an answer for that, because REITs,
Yeah.
you're assuming, is commercial. There
Yeah.
are residential REITs which exist globally.
Yeah.
And on your part about government also, I'm sorry, Shubhit, but maybe I have to go back on your statement. But government has already acted on it last year.
Has already
They have already acted on it in July last year. It has not taken off because of some small issues in the ARSC, the Affordable Rental Housing Complex scheme. They have two models under that, but so much has, I think everybody has gone through so much in last couple of years that some of those finer things are getting lost. But there is definite seriousness, because you can't get everybody to buy a house. You shift into a city, you are pre-30s. You can't say, okay, fine, start buying a house and do all those things. Yes, we would love them to do that, but there has to be a play where I can get a decent house at right rent, and still be so-called asset light, which was a flavor till 2 years back.
No, I agree with you. Rental housing and is here to stay and probably grow from where we are, and we are just at the cusp. Before I end the session, just two more questions, one for Vikas and one for Nitin. Vikas, your fund is a little bit more agnostic. It goes beyond housing. Are you seeing opportunities on retail, data centers, or warehouses? Where else are you deploying other than Resi? Can't hear you. Can't hear you.
We are at this point of time, historically, we have deployed, these are more special situations, kind of a situation, Shobit, projects which are stuck, whether it is retail, hospitality, or commercial. And that's where we are looking at deploying capital. And at this point of time, more we are seeing is stuck situations in hospitality as well as in commercial, because some of the players are facing challenges in terms of financial closure or last mile to complete some of those projects. So that's where we are seeing retail, not as much because uh, scale or the number of projects are limited in terms of the job markets which we are looking at. But retail, obviously, I'm sure in tier 2 cities, there are opportunities from a last mile completion point of view.
Thank you, Vikas. And I can't let go of Nitin without getting some confidential information out. So, how many more companies can we see go public? And are these largely residential led? or you're seeing likewise retail and more pipeline on the warehousing and commercial side?
No, so I think you'll see, a bunch of stuff. Residential has been elusive till now, but I think the tailwinds that we have now, you will see that, and there is room, right? I mean, you have just a dozen players. I mean, as a percentage of contribution to the exchanges, to our indice, what is real estate? It's very very underrepresented. So you will have room. There is room, and you will see some of the smaller guys grow, and you will see some very efficient new business models come to market also, uh, on the residential side. And on the commercial, I think it's residential and REITs more so for me, and within that umbrella of REITs, uh, I'm thinking Vipul's going to come with a residential REIT really soon as well. uh, so that's definitely coming. But even outside of that, offices here, retail is around the corner, multi-use is definitely going to be there. Warehousing, logistics, so much has been built. All of this will need an exit. You will see even that get listed. And what is more heartening to see is, and we've been part of every transaction on the capital markets today, and in every transaction after transaction, the participation has just gotten wider, right? Initial first REIT was just the foreign money. Then you saw, the domestic trickling in. The third transaction saw a lot more domestic, and all through this, what was extremely heartening to see was the non-institutional understanding and appreciation of this product. I mean, the HNI and the retail guys just love this product. I mean, as Indians, we have this penchant for real estate, and explained well. And I think all of us, all participants, have done a good job of explaining how REITs work to these guys, and they have a lot of appreciation for this. I mean, it's easier to sort of fill the non-institutional bucket of issue than the institutional side when it comes to REITs, and even InvITs for that matter.
Fingers crossed. I think we are eating into other panels' time, but quick summary of what I've understood from the panels over the time is residential upcycle started, sales are doing very well. The listed companies are reporting record sales, and it seems like whether it is money for affordable housing, perhaps for starting up for rental housing, retail, warehouse. There's appetite all along, whether it's private or public. With that, I'd like to thank you all for sharing your views so candidly. Thank you, CII and ANAROCK, for hosting us all. Thank you once again.
Thank you.
Thank you so much.
Thank you. A big thank you to all the panelists and, of course, to Shobit for leading this panel discussion and steering it around the corner.